Let's begin with the obvious. Today was an important day for the bond market because we got a Fed statement. Any surprises for you in the Fed statement?
Not much. You know, they spoke to transitorily low inflation. Same thing in terms of growth. We had a GDP number today at
kind of a hideous GDP number.
0.2%. Actually, real final sales, which scratches out inventories, was a minus 0.5%. So really hideous and with that negative number. But I don't think the statement suggested much difference in terms of their attitude going forward. They think inflation's going higher to hopefully to 2%. They think real GDP is in a 2 to 3% zone, and so they're going to sit and wait until they get there.
So what conclusions then do you draw about the timing of a rate increase right now?
Well, I think it's off in June. Some would say if we get a strong employment report a week from now that perhaps it's back on, but I think it's off. And I think perhaps they simply want to get off the dime. They want to prove that they're not healthy, but that they can get out of bed and stand on their own two legs, and that means, you know, a 25 basis point increase perhaps in September or December. But from that point forward, and that's the key, you know, how quickly will they move back to what you know, we know as a new neutral policy rate.
And what would that be?
Well, to my way of thinking, that it would be 2% nominal and 0% real. Now, the old standard, the John Taylor rule standard, was basically a 4% nominal rate and a 2% real rate. Just, you know, some of the Fed members, a lot of the dots, those blue dots, you know, basically suggest that 3 3/4 to 4% nominal is still the number, but I hesitate.
So as far as June is concerned, you don't read anything into the FOMC removing that sentence from the previous two statements about an increase in the Fed's funds target being unlikely at the next meeting?
I don't think so. They were moving in that direction. I mean, they had a transition 4 or 5 times in terms of the language, and I think they want the language out of there in terms of time dependency. They want to be data dependent, and the data, you know, to a considerable extent revolves around employment, labor, and inflation.
Do you think it's important for Janet Yellen and her colleagues to be able to prove that, in your words, they can get out of bed and stand on their own 2 feet?
I think so, and I think it's important from the standpoint of the health of a capitalistic economy, which is something that hasn't been discussed a lot in terms of Fed meetings, but I think low interest rates can have negatives as well as positives. I mean, the Fed has always sensed that the lower the rate, the better in terms of stimulating the economy, capital markets, stocks, you know, flow down in terms of wealth, et cetera, et cetera. But at some point, when rates are so low, you know, you keep alive zombie corporations because they can borrow so cheaply. You basically, you know, promote a situation in which business models, pension funds, insurance companies, banks, you know, can't earn what they're supposed to earn. And so at some point, capitalism at the margin, not totally, but at the margin, begins to break down. And so I think it is important that they move back up to at least a semblance of a healthy Fed funds rate.